This is Asia Trade. I'm Shery in Tokyo.
I'm Avril in Singapore. The top stories this hour. Asian equities set to extend losses from Wall Street as hawkish Fed commentary lowers bets on a December rate cut. Traders dumping risky assets from tech stocks to crypto. China data out later expected to show the longest slowdown in consumption growth in more than 4 years, while credit demand dries up. Also ahead, Tencent's better-than-expected sales growth validates its measured approach to AI development as it resolves a dispute with Apple over app revenue.
And I'm Stephen Engel in Shanghai as finance industry leaders and policymakers gather here for the 20th Citi China Conference. We'll be speaking exclusively with the Citi Global Chief Economist Nathan Sheets, as well as the head of banking, Vis Raghavan, and later, the CEO herself, Jane Fraser.
And take a look at how we're setting up across the markets in Asia after that massive sell-off that we saw on Wall Street. Of course, we didn't see any support from traditional havens, the likes of the dollar, gold, treasuries, all falling. Take a look at the Japanese yen holding at that 154 level against the U.S. dollar. We actually had this weakness going to the 155 level, prompting really those warnings coming from the finance minister. Potential verbal intervention that could be coupled with action is key here in Japan. Nikkei futures holding steady after 2 sessions of gains early in the Asian session. We are seeing Australian stocks under pressure, down more than 1.6%. And we're seeing some support for the offshore yuan gains for the last 4 sessions or so. Of course, we continue to see dollar weakness. The activity data in China will be very important as we continue to follow the latest developments on the trade front as well. We are hearing from the New York Times that President Trump is talking about these exemptions that will only apply to certain reciprocal tariffs. So we'll continue to watch those latest trade developments, but President Trump has not made a final decision on those exemptions as of yet, Avril.
That's right, Shery. Part of efforts perhaps to help cap food prices. So these tariff exemptions we're hearing could include for beef and citrus products, although, as you said, Trump has not made a final decision on this. Exemptions would apply to certain reciprocal tariffs. Again, that report from the New York Times. But let's recap how Wall Street did overnight as well, because we saw heavy selling and stocks had their worst day in more than a month following hawkish comments from Fed officials, which we'll get to in a bit. But overall, we are seeing money markets putting odds of a December cut below 50% now. So not even a coin toss, right? We also had on stocks those concerns about valuations resurfacing. There was some rotation into more defensive names. The 10-year yield overnight went from roughly 406 to 412. We are seeing Treasury futures also for the moment looking pretty flat, but all this, worth noting, is coming ahead of a wave of data as the government reopens. The dollar is at roughly 2-week lows. Now, in terms of the data, we are waiting to see what we will actually get, some indication that we won't have jobless numbers. Take a listen to what Kevin Hassett had to say about that.
The September jobs report has already been cooked, and we expect we might get that next week. It just hadn't been released. The October employment report for the payroll side will be able to be calculated, but the household survey wasn't completed, so we'll get sort of half a jobs report. Most everything else, I think, we'll be able to concoct the correct number after we look back, but we will never know what the unemployment rate was in October because there wasn't a household survey.
Let's delve into the U.S. economy and get more from global economy correspondent Enda Curran. And Enda, given that we really lack the data coming from the U.S. government shutdown and that fallout, we have been trying to gauge what the Fed is thinking. Take a listen first as some of the Fed speak that was seen as more hawkish this time around.
We need to proceed and tread with caution because I think there's limited room for further easing without monetary policy becoming overly accommodative. I believe policy right now is somewhere between modestly restrictive and neutral. We need to continue to lean against above target inflation while providing some support to the labor market.
When I look at both of those things, on balance, I think we need to remain somewhat restrictive to continue putting pressure to bring inflation down towards our target.
Perhaps not surprising that markets are now pricing odds of a rate cut in December to below 50%. What are you watching, Enda?
Well, the first things first, we're now going to start getting government data again, Shery, for the first time since obviously the very end of, since the government shutdown began. As Kevin Hassett said, we will get the September jobs numbers at some point over the coming week. Okay, then we're going to get at least partial reading on October jobs data. You know, he heard him say the household survey wasn't done, so we won't be getting the unemployment rate, but we'll be getting some picture in terms of where the employment story is. And then we'll start to see what schedule the Statistics Bureau puts out in terms of when will we start to get the rest of the data. So we're at a point now where there's new information coming. It will start helping to build a picture for the Fed and the Fed debate. Obviously, there's going to be a side story around a lot of scrutiny on this data. How can it be trusted, given such a choppy period with the government shutdown? But, you know, we'll certainly have a broader picture than where we have been, and that will either lean into the Hawks view or lean into the Doves view.
On that note, I mean, how much can Fed officials actually rely on the data, to your point about the questioning about the quality of all this that's coming in? And what indication do we have on not just, you know, perhaps how businesses are doing, but how households are doing, given what Kevin Hassett has been saying?
Well, we have been getting mixed signals. You know, plenty of private sector indicators out there during the government shutdown pointing at perhaps hints of softening in the jobs market. We know Avril as well. Some big companies, well-known brands, are talking about cutting staff and letting go workers. And anecdotally then as well, we hear a mixed picture on the retail side. The headline suggests consumer spending is strong, but then, of course, economists will tell you it's split between higher income earners and those lower down the income ladder, so to speak. So it's a complicated picture. It's complicated on the inflation front. It's complicated in terms of what spending is going on, who's doing that spending, and it's not clear what's happening on the labour market. Okay, it's softening, but how soft is it? Does it reflect outright job cuts? Does it reflect the immigration crackdown story? So all of that's complicating the Fed story, and what we've had over the past few days now are several Fed officials coming out, mostly this week actually on the hawkish side of things. You just played a clip from Beth Hammack, for example, Alberto Moslam also making the point, look, we have to worry here about the inflation story. It's still at 3% above the 2% target. So it has been a week for the hawks, no doubt about it. We'll have to wait and see if we hear from doves over the coming days. But right here, right now, it does feel like the market and sentiment is tilting towards, at the very least, that Fed decision in December being wide open, if not tilting towards a hold according to market pricing.
And thanks so much for running us through these nuances. Our global economy correspondent, Enda Curran. Now let's get more market analysis with Terri Spath. She is founder and CIO at Zuma Wealth. Terri, good to see you. So as Enda was just highlighting, you know, we're not quite sure about December. Maybe the hawks are coming through in terms of commentary this week. How much does the rate environment mean bigger risks for the AI rally going into next year?
Hi, Avril. Hi, Shery. Thanks for having me on a day when there's really no fundamental news, but there's been such a big shift in the market in terms of just the red on the screen that it makes sense to kind of step back and figure out what's going on. I think you've hit the nail on the head by, you know, highlighting that these comments that are coming out of certain members of the Fed have, you know, created this shift in, or a little bit of fear of like, does the Fed really have our back in December? There's been this, you know, bet that the Fed will be there if something bad happens, and, you know, maybe they're not going to be there in December. That's what's really come out. And it's interesting, right? Because the government shutdown ended, and that seemed to get it didn't calm the markets at all. It's been this classic, you know, buy the rumors, sell the news, and this big shift now to what is the Fed going to do in December. And, you know, I think it's fair to be concerned that they're not going to cut, but at the same time, I don't think that that's a major problem for the trend in the market, which is, you know, up and to the right. Not today for sure, but the Fed is certainly going to get all the same data that the rest of us are going to get in terms of employment numbers, in terms of inflation. And I think what's going to be key is not necessarily do they cut in December, or if they cut the equivalent of 2 cuts, you know, 50 basis points, 25 basis points, don't cut at all. But what they're seeing in The data, I think, will inform the markets at that time. But going into 2026, I think we can be pretty confident that regardless of what happens in December, we're still going to see an environment where interest rates are coming down over kind of the more 3, 6, 9 months time frame. And I think that is going to calm, a lot of investors down.
So to your point, I guess the Fed eventually will sort of have our bags. But you've made some recent changes to how bullish you are overall on markets to moderately bullish, and you're putting in place some guardrails. What are these guardrails?
Sure. Yeah. I mean, we're still bullish. Let me just be clear about that. And the reason for that, there's several reasons. Earnings are good. And that earnings are what drives stock prices. The Fed's, bias is to cutting interest rates. That helps everything in the cap scale, particularly the smaller cap stocks. So we still think that those two driving forces, improving earnings and a falling interest rate environment, are going to be good for investors. I think what happened and what's happening in November, not just today, is that we got to a really high level. It's like if you're flying in an airplane, you're at high level, everything's fine, and all of a sudden you hit turbulence. The pilot doesn't go further up, he comes down a little bit. And I think that's what's going on in the markets right now. Is we've hit some turbulence. We're looking around. Okay, if we have the option to own a tech stock versus something with a little bit lower valuation, is that something that makes sense at this point? And I think that's what we're evaluating, as well as other investors, to make sure that we're balanced in earnings as well as valuation.
Does that actually then perhaps make the market more healthy, that you're seeing actually broadening out into other sectors?
I think it makes the market more healthy. I would say that. I mean, if we look at the past 3 months, it's interesting. The Dow has outperformed the S&P 500 and the NASDAQ over the past 3 months. And I think what that is showing is that investors are, going a little bit back to basics. So I play pickleball, and when I'm losing in pickleball, I'm always told, go back to basics, start moving your feet. What's going back to basics in investing? It's looking at earnings. So NVIDIA is going to have spectacular earnings, but so is Goldman Sachs. And when you have the difference between, a 40 or 50 PE on a tech stock and a 16, 17 times on another stock, well, perhaps you want to make sure that you've got exposure to both of those. You want the high growth, but you also want the good valuation. And so that's what we think makes sense at this stage.
I was going to say, how big of a catalyst would NVIDIA's earnings next week be at a time when we're also seeing the risks and concerns about these circular deals of money just going back and forth between NVIDIA and other tech giants and startups as well?
Right. I think the NVIDIA news is going to be huge. It always is. They give a lot of information. I think their earnings are going to be terrific. Their earnings are always terrific. I'd be very surprised if they're anything different than that. It's going to be how the market reacts to what they say, how they're feeling about the valuation given the earnings numbers that come out. And I think that there's a little bit of air coming out of the AI trade. There's a little bit more, I think, back to your point about being healthy, it's sort of what makes sense. Not just anyone that comes out and says, I've got AI, and buying that stock, but who's really participating, who's really going to be the winners coming out of this. And I think that revaluation is going to be a front, burner area of focus when NVIDIA reports, as it is every day, but we're just going to have some more information next week when that comes out. And I think that'll be helpful for investors. It'll help us inform how we want to position through the rest of this year and then going into 2026.
Yeah, so how would you be looking at the metrics in terms of picking the future AI winners then?
Well, I think that's really difficult to say at this point, and I think that's what the challenge is. I do buy into this, the belief that there is so much productivity gains, so much cost efficiencies, so much creativity that's going to be coming out of this shift, this paradigm shift. But there's real earnings for a lot of these companies, and there's real benefits for a lot of these companies, which is a lot different. One of the common questions I've been getting right now from clients and investors is like, is this a bubble? And in 1999, when there was absolutely a bubble, a lot of these companies didn't have earnings at all and no, outlook for earnings. For those types of stocks that are out there, obviously you want to get out of those. Those are just pure gambles. But for the rest, it's really, I think having a basket approach at this point, for me, for our clients, is what makes sense, because we don't know who's going to emerge. We don't know exactly what this is going to look like, but we do want exposure to that. So again, having that in their portfolio, but as well, making sure that we've got kind of the better valuations, strong growth, high dividend yield plays in there as well, to balance out the fact that we have days like we're having now in November that are going to be really painful for the portfolio.
Terri Spath, always good to talk to you, founder and CIO at Zuma Wealth. We have more ahead on the Asia trade. This is Bloomberg. China's monthly economic indicators out today are expected to confirm the longest slowdown in consumption growth since its post-COVID rebound lost steam more than 4 years ago. That's underscoring how the government's rhetoric about supporting domestic demand has struggled to match reality. Let's bring in our China correspondent, Min Lo in Hong Kong. Min, we're getting retail sales, industrial production, fixed asset investments. What are we expecting?
Yeah, I mean, I think the big focus will be on retail sales, because economists are forecasting a 2.8% growth, which will be the 5th straight month of deceleration. And as you said, the longest slowdown in about 4 years, 2.8%. That's also going to be the slowest growth in more than a year. And you can see the bigger picture, everything else also not looking great as well. Industrial production expected to slow down to 5.5% versus 6.5% the previous month. Property investments continuing to see double-digit declines there. Fixed asset investment as well, deepening declines to 0.8% versus 0.5% the previous month. Jobless rate expected to still be elevated at 5.2%. And so this shows you that the government efforts so far to boost consumption with the subsidies, while they have seen pretty strong impact, it's still not enough, right? And economists are still saying that the government needs deeper reforms to really raise the purchasing power of households. And we got a hint of that slowdown in the retail sales numbers from the Golden Week holiday, seeing pretty lukewarm numbers as well. So all eyes are on what the implications would be when it comes to government policy moving forward.
Mimi, we already got the credit data showing the weakest growth in more than a year. What do they tell us about the Chinese economy? How bad are the numbers?
Yeah, again, pretty disappointing on that front as well, because the aggregate financing numbers came in at about 815 billion yuan. It's far short of estimates of 1.2 trillion yuan. And you look at the new loans, that is below expectations, and the weak demand coming both from corporates and households. Corporate growth and corporate credit growth came in less than a fifth of what it was a year ago, and household mid to long-term credit also contracting once again, and that's often a proxy for mortgages. It shows you that people are shying away from buying more properties. You look at total outstanding loans to the economy, that's also declining, which shows you that people are paying back more loans than they're taking out. And a part of it is also because government sales, the pace of that, government bond sales, had been slowing down as well, because the government had front-loaded a lot of the bond sales to the early part of the year. And so quite disappointing numbers, but the PBOC did indicate that they were more tolerant of the slower credit growth, saying that it's natural given the economy is transitioning from high growth to high quality growth. So yes, some economists are also pushing back expectations for any policy rate cuts from this quarter to next quarter in 2026.
Min, thank you so much. We'll watch the numbers in a couple of hours from now. Bloomberg's China correspondent, Min Lo. Now, we also got Tencent earnings, and ADRs were little changed in New York after it posted a faster than anticipated 15% rise in revenue, and this was driven by a 43% surge in international gaming sales. Bloomberg Tech correspondent Annabelle Drawlers joins us from Hong Kong. So, Belle, looking at the scorecard, looks pretty solid, but there's also interesting takeaways from its AI strategy, perhaps less conservative or more conservative than its rivals. What are your key takeaways?
Yeah, exactly. I mean, I think the numbers really validate the argument that we were laying out ahead of the numbers yesterday, or the results. But this is a company, to your point, that can afford to be a little bit more measured in its approach to AI than its peers in China. It's not exposed to the cutthroat price wars among JD, Alibaba, Meituan, and those factors as well showed in the figures. So we got a 15% rise in revenue. You can see there that was faster than anticipated. Sales of more than 190 billion yuan for the 3 months ending September, or just north of $27 billion US. What was the real standout, and you can't see it there, but it was the real standout, was international gaming revenue, because that surged 43%. So Tencent now is really one of the very few major tech companies within China to report significant quarterly earnings growth for the company. Investors as well are really starting to reward this approach as well, that sort of measured approach on AI, plus the strength in the games business, because you've seen a bit of a reappreciation taking place in the stock price over this month. It's up more than 4%, for instance, at this point. Not to say Tencent isn't using AI. It is. It's just integrating across its business services instead.
And Annabelle, perhaps some positive news coming for Tencent as well when it comes to that high-profile dispute and striking finally a deal with Apple on WeChat mini games.
Yeah, that's right. So this was a scoop for us here at Bloomberg, but I think we should probably set out exactly what a mini app is first. So we're essentially talking about smaller, more lightweight applications that run in large super apps. So in the case of Tencent, you're talking here about mini games, which are contained exclusively within WeChat, which many people are familiar with, but it is the equivalent of WhatsApp, used by more than 1 billion Chinese people. Mini games have been growing and growing in popularity, but up until now, Apple hasn't been able to take any slice of the income from purchases because an agreement wasn't in place. But what sources tell us that these negotiations have been protracted, and what has been decided now apparently is that Apple is going to be taking a 15% cut of purchases in WeChat mini apps and games. So this is part of a broader program that Apple announced overnight and will be open to all mini app developers as well. A 15%, it is a lot lower than the 30% that Apple would typically charge, but it does open a new revenue stream for Apple. It takes that pressure off Tencent as well. But mini games, just going back to the numbers and what we had in the results, they were pretty significant because they made up $4.5 billion in revenue for the company in the September quarter. So again, just really underscores why Apple would be looking to get a slice of that as well.
Well, it wasn't just Tencent who beat on sales. It was also JD, and this is following on from its foray into food. What do we know from the numbers about whether its bets are paying off?
Yeah, well, I mean, it was pretty strong actually for JD. As you said, we got that sales beat. Revenue grew 15% for the period, so you did see that impact of consumer subsidies coming across as well. What's been a very aggressive drive into areas or new arenas like food delivery, but sales of nearly 300 billion yuan for the period. That's $42.1 billion, and that was higher than the average analyst projection of around 294 billion yuan instead. Net income, though, it did dive 55% to 5.3 billion yuan. This company, I mean, this week we were talking about as well the Singles Day of sales, and JD certainly said it did very well on that front, but its shares as well. I mean, you saw that reaction because they were up, the ADRs overnight, so we'll of course track it. Well, actually, no, not listed in Hong Kong, so we just got that reaction in ADRs, but again, a move of 3% to the upside.
Bloomberg's Annabelle Jewelers there with some of the biggest tech stories today. We have more ahead on the Asia trade. This is Bloomberg. Traditional havens didn't hold in the overnight session as we saw the likes of gold, the dollar, treasuries all falling in line. In fact, when it came to the gold trade, it was interesting to see that again today we didn't see that haven demand, and really a few times over the past year it hasn't really been able to hold on to gains during an equity sell-off. Take a look at how crude is trading, because we see a little bit of a rebound still, despite the fact that we are seeing more concerns of oversupply for next year. The IEA increasing its estimates for a record global oil surplus next year and expecting expecting just supplies to exceed demand by over 4 million barrels a day. This, despite the sanctions issues around Russia, are leading to more geopolitical risks in the price of energy. Joining us now is Rebecca Babin, Managing Director and Senior Energy Trader at CIBC Private Wealth Group. Rebecca, good to have you with us. Let's talk a little bit about what's happening in oil, because we're seeing a little bit of a rebound in price, but the concerns about oversupply next year are huge and growing at the moment. Will OPEC Plus need to rewrite its playbook at this point?
So I think that's a great question. And just to revert back to what you said on the IEA, the estimates they're putting forth are definitely kind of an outlier. The market is closer to kind of seeing a 1.5 to 2.5 million barrel a day surplus in the first quarter of 2026. So although that headline is jaw-dropping, it's not necessarily where consensus is for that oversupply. When we think about what OPEC needs to do in 2026, there is a consensus they will likely need to pause the unwinds that they have been kind of aggressively putting barrels back on the market in 2025. They announced at their last meeting that they are going to pause those unwinds in the first quarter. It's expected that they will likely need to continue to pause and not unwind the remaining 1.2 million barrels that they have left on their quotas for the remainder of 2026. So I don't know if we see them start to actually cut back and reduce production, but I do think pausing for now and through the course of 2026 is going to be very likely.
When it comes to China and the demand picture over there, things are not looking great. Data this week just showing credit expansion pretty slow. Also consumption data expected today not going to be that great. How big of a concern is that in 2026?
So China is always a concern for crude oil demand. It's one of the primary growth drivers along with India and the rest of Asia. So when we see this kind of lack of acceleration from stimulus or just kind of faltering data, I do think the commodity market, particularly crude oil, pays very close attention. But I will say this. This has been an ongoing issue, as I'm sure you well know. And so estimates for China growth for next year are not extremely high or robust. So, right, we're looking at like 200 to 250,000 barrels a day of demand growth coming out of China, which is a pretty low estimate. So although it's something we watch, and if things continue to deteriorate, we will see weakness. But I'd say we're looking at a pretty low bar for crude oil in terms of what we're expecting, just because the trends have been in place now for kind of a slowing growth profile for China for a while, for over a year.
On the supply side, how much would you say U.S. producers are driving these global oversupply concerns? And what happened to they'll need to see higher prices to pump more?
That's a great question. So the need to see higher prices to pump more kind of narrative got flipped on its head because so many producers in the U.S. have been able to get much more efficient. They drill longer laterals. They continue to innovate and drive down costs. In terms of their impact on the oversupply story, it's interesting. U.S. production is a big part of the story. If we're looking at 1.6 million barrels of supply growth in 2025, let's call the U.S. making up 400,000 barrels of that, 400,000 to 500,000 barrels of that. It's meaningful, but what we should also consider is it's not actually the only driver. We have Guyana, we have Brazil, we have Canada. So there's a number of producers that are increasing in 2025, which is why that non-OPEC supply number is so robust. When we look at 2026, non-OPEC supply growth is looking closer to 1 million barrels a day. So significantly reduced. U.S. is going to continue to increase production, but at a slower rate. And we'll see some of the projects that we saw at Guyana and Brazil maybe slow down as well. So we will still see U.S. play an important role in supply growth, but it's not the only factor to watch as it had been kind of when shale was really exploding. You need to be able to watch Latin America and Canada and other producers as well.
Another factor also, we probably should be discussing these Russia sanctions. I know you've done an analysis on this. What are you seeing the actual impact on supply disruptions?
So this is a great question, and it's hard to say, for sure what the actual impact is, because obviously we're not working with the cleanest of data. But it looks like right now India and China have pulled back on some of their purchases of Russian barrels. How much is kind of a moving target, but we think we're seeing around 1 million to 1.5 million barrels that are kind of being stranded on the water of Russian crude. As both countries, India and China, try to evaluate exactly how do they work around it so that they can avoid the sanctions? B, how aggressively the U.S. is going to try to enforce these sanctions, and if it's worth the risk to buy these barrels. Urals have started trading at a $19 discount to Brent. That's pretty significant. Before these latest round of sanctions were announced, Urals were trading around a $12 discount to Brent. So we've seen that discount really widened out. And I think if we see that discount continue to creep higher, eventually those barrels will find a buyer one way or another, because those discounts are pretty juicy. But right now, 1 million to 1.5 million barrels are certainly at this point trapped on the water. Now, the market sees this as somewhat of a temporary event, so they haven't priced in a huge amount of risk premium for those barrels.
In hauling those barrels, how consequential are rising shipping costs at this point?
So rising shipping costs are consequential not only for those barrels and Russia's ability to offer discounts and move their crude where it can find a buyer, but it's also very relevant when we look at WTI and other producers, right? We just saw inventory builds in the U.S. today of around 6 million barrels. And essentially what's happened is, as the shipping rates have increased, WTI isn't finding its way into Asian markets because it's just too expensive to ship it there. So it's closing out that arb. So shipping costs are a huge factor. We have a fair amount of crude on the water, filling up those tankers, and those prices are absolutely impacting the way the trade flows are working, and will continue to be a key driver to watch, I think, in terms of crude being able to find its way where it needs to go.
Rebecca, we have to leave it there, but great to get your insights. We really appreciate it. Rebecca Babin is Managing Director and Senior Energy Trader at CIBC Private Wealth Group. Now, a reminder that we're live today at the Citi China Conference in Shanghai. Stay tuned for interviews in the next hour with the bank's Global Chief Economist and Global Head of Banking. And later, Citi CEO Jane Fraser joins us exclusively on The China Show. This is Bloomberg.
Take a look at how currencies are trading at the moment. We have seen a sharp drop in the UK pound after a report by the Financial Times. The Prime Minister Keir Starmer and Chancellor Rachel Reeves have actually ditched their plan to increase income tax rates ahead of the budget on November 26th. The Financial Times citing officials briefed on the move, and you can see the downside of 0.3% as the euro holds steady. The euro had already rallied to its strongest mark since late October. If you see the dollar on the other side of that trade, also see a little bit of downside pressure and that murky outlook for the U.S. economy. The Japanese yen holding steady at 154 after touching that 155 level and prompting warnings from the finance minister and really that watch for intervention here in Japan, Avril.
Yeah, Shery, also seeing downside pressure was the stock of Disney overnight. It slumped the most since April, falling almost 8% after posting sales that missed the street. The entertainment giant warns expenses tied to upcoming movie releases, including Zootopia 2, will hit earnings. Disney CFO Hugh Johnston spoke with Bloomberg about the results.
I thought it was a good quarter overall, and frankly, versus Wall Street, we beat expectations by 6 cents. So, as you noted, the experiences business did very, very well. 6% revenue growth, 13% OI growth was terrific. Sports did very strongly while we were launching the new DTC product, which is off to a great start. And then in terms of the entertainment business, it was largely just the overlap of the film slate that drove the numbers. I know the linear business looked a little bit soft, but that's primarily due to the fact that we had India in the numbers last year where we made $84 million and wasn't in the numbers this year. Take that out. Apples to apples basis. Overall, I thought the quarter was good, and it actually allows us to end the year with a lot of momentum as we think about where we are right now. We grew EPS 19% for the year and 19% CAGR for the last 3 years. And that's why we both guided to double-digit EPS growth in 26. And on top of that, doubled the share repurchase and increased the dividend by 50%.
Hugh, good morning. On that momentum, the focus for a lot is streaming, right? And you have the confidence to say streaming is going to continue to be profitable through 2026. What are the factors behind that? What allows you to have the confidence to have such visibility into how that streaming business is going?
Well, of course, streaming always begins with the quality of the content that we have and the quality of the slate that we have going forward. So if you think about the film slate we have right now, number one, we obviously have Zootopia 2, followed by Avatar, followed by The Devil Wears Prada 2, followed by Toy Story 5, Moana, and then we've got an Avengers movie as well. So if I look at all of that playing its way into the streaming service, certainly feel good about those tentpole events. In addition to that, our TV side continues to perform very strongly. The ratings are great. The number of hit shows are great. And then on top of that, we're investing in the product in a significant way, creating a unified app, and in addition to that, improving our recommendation engines and improving the navigation within the DTC app. Put all of that together, and what we really see is just a huge opportunity for growth. We aspire to grow that business double digits, along with the double-digit margins we expect to achieve this coming year. And as a result, I think we're going to continue to see that business do really well and be a real growth driver for Disney.
But the profitability, Hugh, streaming operating income for the first quarter of 2026, you guide to be $375 million. That's a lot less than the street was anticipating. Why is that?
I think it's primarily due to the fact that we're investing in product in the business and we're investing in bundling. So we all know that bundling ultimately is a very profitable thing to invest in. It increases retention, reduces churn, increases engagement, and that's not a theory. We have proof on that.
Hugh, is this the last earnings report and quarter before Disney's board names a successor to Bob Iger as CEO?
That's a great question. So what the board has previously indicated, and I will say the board has been about as transparent as any CEO succession I have ever seen in my long career. What the board has indicated is that will take place sometime during the first calendar quarter of 26. We report in next February. Whether that'll be before or after will be up to the board, but we should have it done by the end of March.
Disney CFO Hugh Johnston speaking with our colleagues Caroline Hyde and Ed Ludlow. And some of the other corporate stories that we're tracking today. Boeing factory workers in the St. Louis area have voted to accept the company's latest 5-year contract offer, ending the longest strike at the playmaker since 1948. The new terms will increase average wages by 24% and include a $6,000 signing bonus. Workers will begin returning to their jobs on Sunday. Bloomberg has learned that Tesla is developing support for Apple's CarPlay system in its vehicles. Sources say the car maker has started testing the capability internally, but a rollout plan has yet to be finalized. Adding CarPlay would mark a reversal for Tesla and CEO Elon Musk, who's been a vocal Apple critic. Sources say Alibaba is preparing an overhaul of its main mobile AI app in the coming months to more closely resemble ChatGPT. We're told Alibaba plans to rename the app as Quen and gradually add agentic AI features to support shopping on platforms including Taobao. The revamp marks one of Alibaba's biggest moves to generate revenue from consumer-facing services. We have more ahead on the Asia trade. This is Bloomberg.
As we count down to the start of trade in Japan, stocks there are in focus, obviously, amid the heavy selling in the U.S. session, and that's poised to extend across Asia. Softbank is in focus as investors rotate away from risky tech names in favor of perhaps more defensive stocks. Our senior stock reporter, Hideyuki Sano, joins us now in the Singapore studio. Welcome to Singapore, Hide. Talk to us about what we're seeing in Softbank just getting battered in the past week and a half. Are investors rotating out of tech? Is this the trend you're seeing?
Yes, there's a sign of that. And I'm glad that you asked about Softbank because there's no better example to illustrate what's going on than Softbank. Now, when you look back, Softbank announced a record quarterly earnings earlier this week of 2.5 trillion yen. And that's a record not just for Softbank Group, but for entire Japanese companies. But the share prices fell 10% in the following session. And of course, there are some explanations about that. But if you think that a record profit cannot lift Softbank share prices, what will? And the question is, people have been buying Softbank Group so much for the last 2 months. So that indicates that a lot of investors were just looking for opportunities to get out of Softbank, and clearly that seems to be what's happening at the moment.
Well, you get out of that trade, where do you go then?
Yeah, that's an interesting question. There are a few candidates, I think. One is banks, which have been depressed because, relatively speaking at least, because of worries about Takaichi's policy, especially the idea that she might try to put pressure on the BOJ not to raise rates. And there are a few other candidates, generally speaking, so-called value stocks. And there are interesting examples like energy companies, like Impex or power companies. And also, if you look at the trading houses, companies such as Sojitz and Armeni have done quite well over the past few weeks. Now these are companies that Warren Buffett has invested, but they are smaller than top-tier companies like Mitsubishi or Itochu. So generally speaking, investors are now trying to rotate to laggards, and that may continue for a while.
Hide, what is this going to mean for the broader topics? Because we are seeing, interestingly, that correlation with the yen is not quite what it used to be. So what are you expecting in terms of whether this rally can extend even in the face of the pressure that's coming on tech stocks?
Yeah, I think for that, I think the global economic and market outlook is critically important. And at the moment, there's talk that the Fed may not cut rates in December. And some investors also paying attention to signs that the U.S. job market may be slowing down a little bit. Now, of course, on the other hand, you have very strong U.S. consumption at the moment. But probably you need investors to closely paying attention to the U.S. economic picture, and that's just because Japan has been dependent on the U.S. economy so much.
Senior stocks reporter Hideyuki Sano there with the latest on the Japanese markets. And given that we're headed towards the market opens in Japan, take a look at some of the stocks that we're watching. Japanese car makers, for example, with Nikkei now reporting that Nissan and Honda are in talks to deepen their partnership. The report cites Nissan CEO saying the car makers are looking to jointly develop products and powertrains in the U.S. Honda's ADRs closed 1% lower in the U.S. session. We'll also be watching chip gear maker Kioxia when it starts trading in Tokyo after quarterly results missed market expectations. ADRs dropped 22% in the U.S. Thursday session, the most in over a month. We had Citi now writing that Kioxia's results were somewhat negative. The CEO, though, sees NAND demand far outpacing supply through 2026. Rakuten's rally over the past 3 months will be tested after operating income missed estimates. The third quarter profit measure of just under 8 billion yen was well below the average analyst estimate of around 23 billion. Still, Bloomberg Intelligence sees growth in Rakuten's fintech business offsetting weakness in its mobile arm.
Shery, here are some of the top global headlines we're following. President Trump expected to return to Davos next year, signaling warmer U.S.-Swiss ties as both sides push to finalize a new tariff deal. According to sources, Trump is preparing to travel to Switzerland with a large delegation for the World Economic Forum. Trump didn't attend this year's meeting, held shortly after his inauguration, and instead spoke by video link. China has summoned Japan's ambassador to protest Prime Minister Sanae Takaichi's comments that a conflict over Taiwan could pose what she called an existential risk to Japan. Chinese Vice Foreign Minister Sun Weidong described the remarks as brazenly provocative, accusing Tokyo of suggesting it might intervene in the Taiwan issue. Sun urged Japan to retract what he labeled as reprehensible comments. Ukrainian President Volodymyr Zelensky says his country's survival depends on fresh funding from allies, urging the EU to approve plans to use frozen Russian assets. Zelensky told us exclusively that Kyiv needs the support by early next year as Russia intensifies strikes on energy infrastructure and pushes forward on the battlefield.
They understand that we need their support, and if, I hope, God bless, we will get this decision, but if they will not have this decision, of course, we together will find we have to find alternatives. It's a question of our surviving. That's why we need it very much, and I count on partners.
And in the next hour, we take you live to the annual Citi China Conference in Shanghai. The market opens in Seoul and Tokyo are next. This is Bloomberg. This is Asia Trade. We're counting down to Asia's major market opens. After another sell-off on Wall Street, Avril, we have those concerns about valuations with tech leading the declines, despite the fact that we saw the end of the longest ever government shutdown. Hawkish Fed speak also making investors anxious.
Yeah, to your point, we're not quite seeing the rally that we've seen following past resolutions of U.S. government shutdowns. We're also watching a slight rotation into some of the value names under the hood. So we'll see how that plays out in the Asia session.
Yeah, that sell the news phenomena that we saw in the overnight session really pressuring treasuries, dollar, gold. Really, the traditional safe havens didn't hold. Take a look at how Japan is coming online, because in the overnight session, we also had a little bit of weakness for the Japanese yen, touching that 155 level against the U.S. dollar. So we had more warnings coming from the finance minister. Of course, we're on intervention watch here in Japan. The Nikkei under pressure, 1%. We're also watching JGBs. They rose in the previous session after smooth 5-year auction. Today, it will be about the three biggest banks that report. We are expecting another record year. Take a look at how South Korea is also coming online, because we had the Kospi gaining for the past 4 sessions. But of course, we are continuing to watch that pressure on those big tech names. And you can see the Kospi losing more than 2.5%. And the Korean won also under pressure at that 1471 level, Avril.
Yeah, we also, of course, saw pressure earlier in the week on oil prices, given the market's focus on the global glut, especially against the backdrop of these forecasts coming in from the OPEC and IEA forecasters. We are seeing that continued rebound in the Asia session, even on WTI moving towards the 59 handle. But of course, as you say, it was about this hawkish Fed speak. So it was interesting. We saw both stocks under pressure. Treasuries also fell. The dollar also, despite what the Fed commentary came in as, was also struggling a little. We are seeing that continued decline in the U.S. 10-year towards that 4.13 handle on yields. We heard from the likes of Neil Kashkari and Mary Daly. They sound undecided on December, but take a listen to what some of the other Fed speakers also had to say.
We need to proceed and tread with caution, because I think there's limited room for further easing without monetary policy becoming overly accommodative. I believe policy right now is somewhere between modestly restrictive and neutral. I believe we need to continue to lean against above target inflation while providing some support to the labor market.
When I look at both of those things, on balance, I think we need to remain somewhat restrictive to continue putting pressure to bring inflation down towards our target.
Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. Garf, the market's now pricing less than 50% odds of a Fed rate cut in December. If there's no Fed put, what does this mean for markets that have already been really stretched at this point?
Yeah, well, I think the biggest difficulty for markets is the uncertainty. Yeah, that's what's really coming to the fore. And I think that's part of what's playing into the way that markets are confounding expectations that once the shutdown was over, they would recover their mojo because, okay, everybody gets back to work and we know where we're going. But we don't know where we're going because it's been unclear what data we're going to get. We're getting this situation where apparently they're going to report on jobs for October, but they won't give an unemployment rate. That's going to make that hard to judge. And we're not going to get the CPI. So in a lot of ways, you get the worst of all possible worlds. You could get a jobs number that shows labor market weakness, but you don't get the unemployment rate, so how much can you trust it? And at the same time, we're not going to get an October CPI. In that case, that really complicates the capacity for the Fed to have any reassurance that inflation is getting back under control, or at least is not getting further out of control. So that's feeding into the concerns that a range of Fed officials have expressed that it might be prudent, to wait rather than cut 25 basis points. Their assessment has been that overall the economy is in decent shape. You could also potentially argue that with the shutdown over, the economy should come back from any weakness that's created. And at the same time, you have inflation worries. So why not wait for 25 basis points? The problem in the market space is that as soon as a central bank sort of pauses or thinks about pausing, markets start to worry about how long that pause may be, that this signals that the central bank involved is willing to stick with a tighter policy path than investors and then traders had been expecting. And that then means you have to re-examine all your assumptions, including, for example, the assumption that the AI boom is going to go on driving shares up relentlessly.
Garf, the lack of data, I guess, is not the only pressure that the Fed faces. We're seeing perhaps these concerns in rates, the money markets as well. How much pressure is the Fed under to help ease this? And what are the risks of perhaps some spillover effect?
Well, so the Fed is facing a fair bit of pressure, to address this. This is, part of its day job, as it were, making sure that the markets function properly. And there's plenty of potential that they will act with some expeditiousness on this. We've had officials from the Fed already saying they might soon need to make some targeted asset purchases to address this problem. The wider concern is, again, all of this adds to the uncertainty. Part of the reasons why we're getting this is that the government is issuing more T-bills. because of the shutdown, and that there's uncertainty as well about whether the Fed should have already stopped its quantitative tightening. Over the longer term, this is likely to prove to be not too big of a deal. If you think back to when we had the Silicon Valley Bank crisis, the Fed stepped in then to make sure that there was sufficient liquidity in the market, which in fact enabled it to go on hiking rates at a time when some had expected it might stop hiking because of the banking wobbles. So the Fed will act, and it's likely to be able to rein in this, especially now that we are going to get a bit more clarity about what's going on when it comes to funding the US government, and we're likely to get a reduction in those bill sales that have caused difficulties. Again, it adds this very uncertain picture now, which is helping to make everybody a lot more cautious and has kind of push the markets off track from the usual expectation is that November is a great month for stocks. Thanksgiving is here. You've got the Thanksgiving start to the Christmas sales period, and everybody gets happy. There's not a lot of happiness out there in the markets, hence the sell-offs that we're seeing.
Yeah. I mean, we went from tariff risks to shutdown risks to back now to the Fed risks, and now you have liquidity concerns. Garfield Reynolds here to break all of this down for us. He leads our Bloomberg and Live Asia coverage. And take a look at some of the movers in the Tokyo session right now. We're watching those automakers because we've heard that Nissan and Honda are in talks to jointly develop products in the U.S., deepening their cooperation, according to the Nikkei. So we are seeing that upside for Nissan, some downside for Honda. Of course, there were some partnership and merger talks earlier among these two automakers that didn't pan out, but we're now seeing perhaps efforts to deepen their partnership. Take a look at Rakuten as well. They missed on operating income for the third quarter. The net loss was much bigger than analyst estimates, but at the same time, their Rakuten Bank is doing pretty well. Their fintech business, not to mention that they saw a little bit of sign of improvement in the mobile sector. Still, it seems that investors today not too happy, down 7%, Avril.
Shery, coming up on the Asia Trade, we're live in Shanghai at the Citi China Conference. Their global chief economist Nathan Sheets joins us, followed by global banking head Viz Raghavan. Much more ahead. This is Bloomberg.
The September jobs report has already been cooked, and we expect we might get that next week. It just hadn't been released. The October employment report for the payroll side will be able to be calculated, but the household survey wasn't completed. So we'll get sort of half a jobs report. Most everything else, I think, we'll be able to concoct the correct number after we look back. But we will never know what the unemployment rate was in October because there wasn't a household survey.
National Economic Council Director Kevin Hassett as the U.S. government slowly reopens following its longest ever shutdown. But today, of course, we have a big data bonanza coming out of China. In the meantime, Citi's annual China conference begins today in Shanghai. Bloomberg's chief North Asia correspondent Steve Engel is there for us. Steve?
Yeah, hi, Avril. Of course, we are just kicking off our coverage here in Shanghai this Friday morning at the Citi China Conference. It's 20th annual conference, and we're kicking off our coverage with Nathan Sheets, Citi Global Chief Economist. Thanks so much for joining us here on Bloomberg Television.
Great to be here.
So, as you know, some of the numbers that come out of the United States because of the government shutdown, not giving a lot of clarity on jobs, unemployment rate for September, October, a bit muddy as well. How would you rate how the U.S. economy is doing right now? You talked about the great bifurcation because there's growth, but then there are significant risks out there.
My surprise this year has been that the U.S. economy, and indeed the global economy as well, have continued to show ongoing resilience. And we have seen tariffs come on as President Trump advertised. But the economy has been able to rewire and adjust to those tariffs surprisingly well. Now, having said that, is everything perfect? No, and that's what the Fed is focused on. Inflation is running higher than their 2% target, and the labor market looks like it may be easing and softening at the moment.
Right, so as companies cut costs, that's really having a feed through on hiring, right? So that's one of the risks again, but AI boom is still ongoing for now.
Yes, I think as you're suggesting, this softening we're seeing in the labor market reflects a variety of factors. One, over the last few years, there's been a lot of hiring in the economy, and those workers are being integrated into business and production. There are some pressures on margins as a result of the tariffs, as you suggest, and AI's in play, and I think we're hearing more and more announcements of future layoffs, and maybe even a few today, that are associated with the increased efficiencies, or at least desired efficiencies associated with AI.
So, of course, the markets are reacting now that the government shutdown issue is at least temporarily solved, is on the bets on the Fed, obviously, and now I think it's tipped to just below 50-50 on whether they're going to ease in the next meeting. Again, does that play to your point about the risks of inflation coming in early part of 2026? Because inflation, even to your admission in your recent report, hasn't been as noticeable after the tariff shock.
Yeah, the economy has absorbed the tariffs with less inflationary pressures. And I think a lot of it is still in the corporate sector. And one of the big debates we have internally is to what extent we're going to see the corporates pass through more of that in 2026, and that stands as an inflation risk. And these are the issues that the Federal Reserve will be debating. On the one hand, inflation is higher than its target. On the other hand, they're thinking about the labor market and where that's going. And when you put it together, it is a very, very close call for this meeting. This is a remarkably divided Fed. And in line with that, I think the markets at the moment are pricing it roughly 50-50. And I think what will determine what the Fed does is the tone of the data that are released between here and the meeting in December.
Well, right. So how much did the government shutdown muddy the clarity on the numbers? Because we've had to use kind of independent, non-official numbers for September.
Well, during the period of the slowdown, of the shutdown rather, there was significant uncertainty as to how the economy was performing. And now that the shutdown is over, we'll see the September data. We should see that, say, over the next week or so. And I think the government can collect successfully data for November, but it leaves a big question mark about will we ever know how the economy was performing in October. Right. That's a very challenging proposition for the statisticians at the statistical agencies to figure out.
We're here in China. What is your pulse check on the challenges obviously facing authorities and policymakers here? Consumption is the big issue, obviously. How do you get consumption? How do you combat persistent deflation now well into its fourth straight year, 3 consecutive years? You have an ongoing property mess. What's front and center in your mind?
Well, on the one hand, and continuing my theme of resilience, the overall economy, overall growth, has continued to perform reasonably well. We see Chinese growth over the next year running in the 4.5% to 5% range. And I think the key driver of that has been export performance, notwithstanding the tariffs and a declining market share in the United States. Export performance has been strong.
But how sustainable is that? And 4.5 is below target.
Yes. And And it is a big debate that we have internally as to how sustainable those exports are. That China's been able to rewire its trade toward ASEAN and Europe and elsewhere. But was that an echo of front-loading in the United States in anticipation of the tariffs, or is that something that we'll see on an ongoing basis? And then, of course, in addition to all of that, as you suggested, lots of questions about private demand and the property sector and the robustness of spending outside of exports and outside of government stimulus.
How do you read the importance of the détente that was sort of reached, the truce? So we're going to sort of renegotiate these long-standing issues every year. So we might have a 14-month pause right now until the end of next year. But again, as we've seen, hiccups come along the way and derail trade truces before. So how much time is it for détente and getting back on what some would say is the right track, or are we going to have these shocks that are going to destabilize a path really of that is towards de-risking on both sides?
Yes, and I think what we're going to see going forward is much like what we've seen over the last 5 years. I call it strategic competition, even a degree of rivalry, but also with the recognition that, one, these are the two largest national economies in the world, and what they do matters for themselves, but for everyone else as well. And second, there are some key issues where we are still interdependent, and where China matters meaningfully for the United States and vice versa. So I was encouraged by the détente, by the trade deal that was struck. And my baseline would be that we'll see these periods of tension, but ultimately deals like this will continue to be agreed to going forward. And it will be rocky, it will be bouncy, but in general, it won't be too disruptive for either economy.
Well, Nathan, I'm sure we're going to have a lot to talk about in 2026. We've removed the government shutdown headwinds. We've removed, for now at least, the headwinds from the U.S.-China impasse. Trump and Xi have met. Now we'll have a lot to chew on in the beginning part of the year. Nathan, thanks so much for kicking off our coverage and having us here at the Citi China Conference here. Okay, guys, going to send it back to you. We've kicked off our coverage. Lots more coming up. Obviously, a lot of key interviews exclusively here from the Citi Conference.
Yeah, Stephen Engel there with more conversations later today, including exclusively with Citi's global head of banking, not to mention CEO Jane Fraser also joining the China show. We do have breaking news at the moment, a lot of movement in the FX space. South Korea will discuss foreign exchange stabilization steps with the National Pension Fund. It's preparing discussions with the National Pension. Expectations on weaker won could be entrenched, so South Korea will actively use all available tools to stabilize the currency. South Korea says that demand for bonds is sound given the WGBI inclusion. We are seeing the Korean won right now trading at that 1462 level, a little bit of strength. We have seen in the past authorities in South Korea efforting to put some support for the Korean won with working together with the National Pension Fund. So we're hearing a little bit more details on what else could be done, as we have seen this immense pressure on the Korean won, not necessarily just because of dollar strength or moves, but also because we have seen these foreign outflows from tech companies like SK Hynix and just a broader local stock market as well, Avril.
Absolutely. And I think you're also seeing that in Japan, right? The flow out of tech stocks, some of it to do with this hawkish Fed speak that we got overnight, including from the likes of Beth Hammock and some others who say they're undecided about December rate cut. For Softbank, this is extension into a third day of decline. So I think it takes losses to about 14% down. All things considered, though, it's at the lowest since early October. So you have to consider as well this monster climb we've been seeing in the tech giant. We have more ahead on the Asia trade. This is Bloomberg.
Broad downside across markets in Asia, with the Nikkei falling for the first time in 3 sessions. But financials are still in the green at the moment. Let's get a preview of today's bank earnings from Asia's investing and finance editor, Russell Ward. Russell, so we have the 3 biggest banks reporting today. What are we expecting?
Morning, Shery. Yeah, we're expecting another solid quarter from the mega banks. Firstly, we're going to have Mizuho at 3:30, quickly followed by MUFG and then Sumitomo Mitsui. And really, it's the same dynamics that we've seen for the past few quarters. They're going to be benefiting from the higher rates at home, with the BOJ having hiked rates a few times since last year. That's boosting their lending profitability at home. Also, they're likely to be booking more gains from sales of their cross-shareholdings. They've been reducing these shareholdings as part of the corporate governance reforms in Japan. And of course, with the Japanese stock market pretty buoyant, they're going to be booking some pretty healthy gains from those as well. And then the other factor is the weak yen. That's also a tailwind because the banks have pretty expansive overseas operations now. So those repatriated earnings are going to get a lift from that as well.
Russell, are we likely to see banks raising their profit forecast, or are they going to be a bit more conservative, especially with the uncertainty perhaps surrounding Takaichi's policies impact on these lenders?
Yeah, that's a good question. So we already saw Mizuho actually raise its profit forecast last quarter, and so we're expecting the other 2 banks to join Mizuho this time. You're right about the banks being conservative in their outlooks. Back in May, when they announced these forecasts, which incidentally are for record profits, they were quite conservative, quite open about that, and the things that was concerning them at that time was, of course, the risks from the tariffs. It was only just a few weeks after, Trump's big tariff announcements. But those risks seem to have subsided somewhat. Financial markets have performed well. The economy remains pretty solid. The tariff deal has been negotiated. And now, as you say, perhaps some risks are more turning towards the sort of domestic front, with the new Prime Minister, Sanae Takaichi, not really favouring a tighter monetary policy. Also, her fiscal policy, the questions over that being quite loose. So there's the potential risk for, perhaps Japan's debt profile deteriorating. That's never going to be good for banks as well. And if she does exert some influence over the BOJ's tightening program, then that's not going to be favourable for banks either. But we had Mizuho's CEO Kihara speak on Bloomberg TV last week, and he was actually pretty sanguine and positive about the outlook for the economy and for the bank's prospects under Takaichi. So, we'll have to see what the CEOs say this afternoon.
Russell, thanks for getting us set up. In the meantime, our finance editor, Russell Ward, we're seeing in terms of FX, as Russell just highlighted, that weakness coming through in the yen. But take a look as well at the euro. It has been climbing for much of the past week. And this is really being driven by the divergent central bank policy. I mean, you think about how the Federal Reserve commentary has been coming in, though. Does that kind of change the calculus? We are seeing how the euro rally has been underpinning the weakness we've been seeing in the greenback. Just taking a look as well at how the pound is faring after the Financial Times reported that both Keir Starmer and Rachel Reeves could be ditching that budget plan to raise income taxes. So something that could be playing out and putting further downward pressure on the British pound for the moment. We have more ahead on the Asia trade. This is Bloomberg.
We're watching the shares of Kioxia, the Japanese chip equipment maker, which is now falling by the daily limit after the second quarter earnings missed analysts' expectations. In fact, when it came to ADRs, they fell more than 20%. So you can see right there that Kioxia is, after falling, is expected to fall by the daily limit after those second quarter earnings. We had seen, of course, the shares of other computer hardware and storage companies falling in pre-market trading following following the Kioxia news. Although the CEO does see NAND demand far outpacing supply through 2026, we continue to watch the stock for more reaction from those earnings results. Take a look at the broader market because it's also a down day across Asia. We're talking about the Nikkei falling for the first time in 3 sessions. The Kospi is also down, and we had just heard from South Korean authorities that they're prepared to take foreign exchange steps after discussing with the National Pension Service given the weakness of the Korean won. And you're seeing the ASX 200 also losing more than 1% on a day when we have plenty to digest, including eco data out of China as well, Avril.
Yeah, and as we see that pressure playing out in the yen, also worth highlighting what we're seeing in the pound and to some of the global headlines that we're following as well. The UK Prime Minister Keir Starmer and Chancellor Rachel Reeves reportedly scrapping a plan to raise income tax rates. The Financial Times reports that concerns over a potential backlash from voters and Labour lawmakers is behind the move. The report says the Chancellor is now looking for other ways to fill an estimated £30 billion fiscal gap. And China's securities watchdog chief Wu Ting is reportedly seeking approval to step down due to ill health. But the Reuters report says it's not clear whether his resignation has been accepted. The CSRC posted photos after the report showing Wu meeting with market regulators in France and Brazil. Wu was only appointed in February last year and is known as the broker butcher after a previous crackdown on securities trading firms. China has summoned Japan's ambassador to protest Prime Minister Sanae Takaichi's comments that a conflict over Taiwan could pose what she called an existential risk to Japan. Chinese Vice Foreign Minister Sun Weidong described the remarks as brazenly provocative, accusing Tokyo of suggesting it might intervene in the Taiwan issue. Sun urged Japan to retract what he labeled as reprehensible comments. President Trump is expected to return to Davos next year, signaling warmer U.S.-Swiss ties as both sides push to finalize a new tariff deal. According to sources, Trump is preparing to travel to Switzerland with a large delegation for the World Economic Forum. Trump didn't attend this year's meeting, held shortly after his inauguration, and instead spoke by video link. Ukrainian President Volodymyr Zelensky says his country's survival depends on fresh funding from allies, urging the EU to approve plans to use frozen Russian assets. Zelensky told us exclusively that Kyiv needs the support by early next year as Russia intensifies strikes on energy infrastructure and pushes forward on the battlefield.
They understand that we need their support, and if, I hope, God bless, we will get this decision, but they will not have this decision. Of course, we together will find we have to find alternatives. It's a question of our surviving. That's why we need it very much, and I count on partners.
Let's turn to China. Monthly economic indicators out today are expected to confirm the longest slowdown in consumption growth since its post-COVID rebound lost steam more than 4 years ago, thus underscoring how the government's rhetoric about supporting domestic demand has struggled to match reality. Let's bring in our China correspondent Mimi Lo in Hong Kong. Mimi, so what are we expecting from all of the data today?
Yeah, I think a key highlight to watch out for is the retail sales numbers because economists are now forecasting a 2.8% growth. Now, if that is true, then we would be seeing the 5th straight month of deceleration in consumption growth so far. That is the longest we've seen in 4 years. It's also the weakest number we have seen in more than a year. But you look at the other indicators, not looking too good as well. Industrial production expected to slow down to 5.5% versus the previous month was 6.5%. Survey jobless rate expected to remain elevated at 5.2%. Property investment still seeing double-digit decline, and fixed asset investment continuing to contract even further by 0.8% versus 0.5% the previous month. So a key focus will be what the government will take away from this and what this means for policy stimulus. But the expectation is, because there is not much time left to the rest of the year, growth is expected to hit the target of around 5%. So economists are not expecting strong stimulus this year, but HSBC is saying we could see the government extending more subsidies to goods and also services next year as they try to work towards boosting consumption in the longer term. The good thing is the trade truce has extended and the US has been signing more deals with other countries, and if global external demand improves, that means China's export could continue to be a growth driver. We might continue to see that bifurcated growth in China next year as well.
Mimi, we already saw data showing this weakest credit expansion in about a year. How bad are the numbers? What might that be showing us about the retail sales numbers that are coming out later?
Yeah, this is very disappointing as well because new loans is coming in below expectations. Total aggregate financing far below expectations, coming in at about 850 billion yuan. Expectations was 1.2 trillion yuan. And the weakness is coming through from households and corporate. Corporate mid to long-term credit is at about a fifth of what it was a year ago. And for household loans, mid to long-term loans, which is a proxy for mortgages, that is continuing to contract, which shows you that people are still shying away from buying property. We are looking out for those home prices data that is supposed to come out today as well, but preliminary numbers showing home sales declining about 40% on year in October, so that's not good as well. You add to that, a lot of the times this aggregate financing number has been boosted by government bond sales, but this time bond sales has been slowing down towards the end of the year because they front-loaded a lot of it at the start of the year, right? And even though the government has been injecting about 1 trillion yuan in stimulus to expand investment, they had this new financing vehicle opening up 500 billion yuan for banks to raise funds through bonds and the like to expand investment, but still we are seeing very, very weak numbers there. So that is extremely concerning, of course, and it points to the sentiment, right, that is very, very sticky and very hard to change despite all the stimulus measures so far.
Min, thank you so much. Bloomberg's China correspondent Min Lo. We have more ahead on the Asia trade. This is Bloomberg.
Welcome back. Let's head straight to Shanghai, where Citi's annual China conference is getting underway. Bloomberg's Stephen Engel is there with our next guest, Steve.
Absolutely. We are kicked off this Friday morning here at the 20th annual China conference from Citi. And we are pleased to have this Raghavan, Citi head of global banking and also the executive vice chair. Thanks so much for joining us.
Good morning. Hi.
And having us here. So I did go back and listen to some of the interviews you did with us at the beginning part of the year in Davos with Jonathan and Lisa. Essentially, you were saying risk is on and that there were a lot of tailwinds. And you said U.S. at the epicenter of all negotiations as the deal flow. Looking back, are there a little bit more headwinds now than there were then? We hadn't gone into the Trump administration yet. We hadn't seen the ferocity, if you will, of the tariff regime. How is your assessment going into 2026 differing from that?
Look, on the face of it, a lot of the headwinds seem to have more clarity. So remember, coming into this year, tariffs were kind of a main feature. Looks like we've landed kind of on most of the tariff framework. If not, it's work in progress. Net-net, the market is taking a lot of comfort that every country will land in some zone which will be palatable to the U.S. and to that nation, and net-net, life goes on. So I think those tariff headwinds, there is an element of kind of acceptance in the market and an expectation in the market that we'll get to a good place. And then if you look at the other headwind we talked about, it was all the geopolitics. You had the Middle Eastern war, you had Russia, Ukraine. Some of those things have still got to play out. But generally, it looks like, there is at least, peace in the Middle East, or we are in the process of peace in the Middle East. So I would say, given the amount of liquidity that is out there, I'm quite, reasonably optimistic on the outlook.
And you're bullish on the AI trade as a whole for deal flow and also internally as well, what you guys are going to be doing with AI. But again, where does that take the M&A train going into 2026? If AI, some have called it a bubble in the markets, but where does that take us for deal flow into 2026?
I think AI is becoming almost existential to most corporates. The transformative powers of AI. I mean, everyone realizes you don't quite know what's around the corner, but everyone knows, wow, this is going to just change the way we consume, change the way we live. And this is beyond data centers and compute and water, power, and all the rest of the stuff. Companies today are all evaluating what does AI mean for me, and that means compute for yourself. It means R&D. It means apps. It means how do you re-engineer your own processes in an AI world, all of which is capital heavy. You need to spend money, you need to invest to harvest and harness the power of AI. So beyond just the kind of the capital needs that the tech industry is needing to build all these infrastructures and data centers and the like, every corporation is sitting now and saying, okay, what does this mean for me? Yeah. What is it going to cost me? What are the efficiencies? What does it mean for my top line? What does it mean for my cost of goods sold? And more importantly, what does it mean for my workforce?
What does it mean for deal flow? Again, you have a reputation for being a relentless deal maker, and I think you've pushed your team. Now you've been on the job about 17 months, right? Just about a year and a half. So what does that mean for deal flow within AI, and what does that look like in 2026?
I mean, this is going to be absolutely hectic. I mean, just when we look at our own pipeline, our M&A pipeline, looking forward to next year, it is one of the richest it's ever been. If you look at this year, I think it's like the second biggest M&A year on record. I mean, we've had over $4 trillion of M&A announced or prosecuted, during the course of 26. Yeah. Roughly $1 trillion or plus, 1.3 trillion or thereabouts was sponsor-led, and we forget the sheer amount of dry powder that the financial sponsor, the private capital pool is. It's like they got about $2.7 trillion waiting to deploy, and they incentivize to deploy. So they're paid to put that to work. So so for M&A, there's a lot of tailwinds with regard to just the ability to power activity. AI is going to be a big part of that. I think the other key driver in M&A, and this is an important one, is valuations. Yes. So when you look at how equity markets have performed, share prices have gone up and up and up, and with that comes responsibility. So if you're a board, you're basically saying, I need to justify the share price, I need to show growth, and if that growth is not forthcoming, investors are going to vote with their feet. Activists are going to be knocking on my door. So boardroom CEOs are saying, okay, where am I going to get that growth from? And if it's not coming organically, I need to go buy and effectively, buy that growth. Yeah. And that has been a big driver because we talked a bit about the sponsored dry powder. Yeah. This year has been a mega, corporate M&A, good old-fashioned company A buying company B has been incredibly dominant in the market.
So how obsessive are you looking at the tables, the ranking tables? The latest Bloomberg ranking put Citibank this year for the first time since 2019, number 4 in M&A advisory work. How important is that to you? Obviously coming over from JPM, which is oftentimes at the top of the table.
Look, I think this is a barometer. For good or bad, in the investment banking business, you have a daily mark-to-market. Yeah. When a deal hits the tape, there is another mark-to-market. So, you have to be all over, whatever deals are happening, not just for league table or, revenue kind of reasons, but deals that happen are very often indicative of the direction of travel. So when one deal happens, very many are likely to follow. So you want to be kind of early, you want to be kind of the lead indicator of themes and trends, but very often when one company in a peer group moves, it's very likely that the rest in that peer group are also going to be likely to move. So you want to be absolutely on top of it.
I can guarantee everybody who's watching this that's in the banking industry is wanting to know about bonuses this year. How is this going to translate into this deal flow if it's going to go into, strong tailwinds into 2026? What are bonuses going to look like for you and for your industry?
I think look like every other bank, we pay for performance, and where there's performance, you absolutely end up paying for it. So I think those themes are almost kind of it's a doctrine, and that is something that culturally institutions really adhere to. So
what's your overall plan for China? Obviously, a few years ago, you guys did withdraw from your retail banking, along with other nations as well. You still have the security license, a wholly owned security license application that is still pending. What's your overall strategy for you, how you want to tackle this market? You've brought a big presence here to this China conference this year.
Look, I mean, you can see the energy in the room here, right? I mean, you have over 2,700 clients, investors. I mean, there's a buzz. I think there have been over 7,000 one-on-one meetings and the like. I mean, the energy is palpable. I mean, it's not just in this room. Just, meeting clients and, just kind of looking at their aspirations and ambitions. I mean, this market is just absolutely, you can see the energy and the vigor. This market is absolutely going to flourish. And we are absolutely everywhere our clients are. So we serve Fortune 500 globally and their desires and their needs into China, and same way we service our China clients into their global ambitions. So it's a very key market. I think you can see the energy here, and they're going to be a key part of the entire kind of global tech boom that you're seeing. So,
what kind of employment footprint would you like to see? I know some of the tech staff have been withdrawn from here. You got rid of the retail banking about 3-4 years ago, but are you looking at really building up Hong Kong because of the IPO boom that we've seen there? Also, wealth management. I think you sold your retail wealth portfolio to HSBC a few years ago as well. So, does wealth management and also the IPO underwriting emphasis really focus on Hong Kong and to another degree Singapore?
So look, our expansion will totally mirror Jane's mission around the 5 clear lines of business, and each of those businesses have incredible kind of corporate clarity, ownership, accountability, and the idea is as we grow, those will be the pillars along which we grow. And you talked about the Hong Kong market. I mean, the market has had, it was up, 28% or thereabouts, the Hang Seng Index this year. And when you look at the valuation of the market, it's trading at 13 times forward PE. 13 times forward PE. Just so you can imagine the amount of inward interest and the upside it is going to attract. So I think there are multiple kind of tailwinds, and in the region, I think China is slowly having a renaissance, and as all the kind of the global streams, etc., calm down and the like, I think once again you'll see a lot of Chinese companies want to access international capital. And you're seeing the beginnings of that capital formation happening already.
How confident are you, though, and I know you don't want to get ahead of regulators, of getting that A-share securities license fully owned here?
Look, we are super committed to China. You said exactly where we are, and I think nothing more to report on top of that. So.
Japan also has seen a new prime minister, pro-stimulus kind of candidate. You've seen the market react upwards as well. What's your outlook there, as well as on the deal flow as well in other parts?
I was just in Tokyo yesterday, so I came over from Tokyo. Similar theme. I mean, we had our global TMT conference in Pebble Beach over the last weekend, and you thought you could see the energy in the valley on the whole kind of the AI tech wave that is coming. You follow that through to Asia, it's almost a continuum. Yeah. Because for every company absolutely at the forefront of that AI wave, there is another company in this part of the world that is part of that whole ecosystem. I think Japan is really having its moment. The whole drive towards corporate clarity, in where companies are now focused on optimizing their net asset value and looking at either sweating their assets better or demerging. You have activists now who are mounting campaigns if you see a sleepy company. Private equity is all over Japan. I mean, first there were like 3 or 4 players. This year, I've seen 10 more come in and open shop. So I do think that Japan is going to be very interesting to watch. It's got some...
The foreign interest there is quite strong right now with the yen at 155.
Spot on. It's a bit nuanced too. There's an aging demographic. Most Japanese corporates cannot entirely look organically or domestically for acquisitions. So you will see more and more Japanese corporates and look abroad to effectively get their acquisition. And we saw that. We advised Nippon Steel on buying U.S. steel, for instance. So you'll see more of that.
Thanks so much. I could go on and on and on.
No.
We didn't talk about India. We didn't talk about the Middle East. New Riyadh headquarters. Lots to talk about. But we'll continue the conversation with your CEO, Jane Fraser, later in the morning as we have this exclusive coverage from the Citi China conference here in Shanghai. Avril, back to you.
Steve, thank you. And as Steve mentioned, we have more ahead on the Citi China conference in Shanghai. In the next hour, we'll speak exclusively with Hopewell Chairman Gordon Wu and former U.S. Ambassador to China Nicholas Burns, as well as Citi CEO Jane Fraser. She joins us at 10:30 a.m. if you're watching in Hong Kong, 9:30 p.m. in New York. We have more ahead on the Asia trade. This is Bloomberg.
The Korean won strengthening early in the Asian session after we heard Avril from authorities in South Korea that they're going to use any tool necessary in order to support the currency. Of course, we continue to see the weakness across the board in Asian currencies, but the Korean won has performed particularly badly, -6% in the past 3 months or so, the biggest loser across Asia. And it's not just about currency dynamics. It's a persistent stock outflows with locals investing overseas as well. So South Korean authorities want to prepare foreign exchange steps after discussing with the National Pension Service. And this is interesting. This is an $860 billion pension fund that has used a strategy of selling dollars in the past in order to support the Korean currency.
Yeah, and we know that it did so in January, selling the dollar, buying the won. And of course, NPS is the largest institutional investor, and it's doing this perhaps through hedging as well as through FX positioning to help to support the Korean currency. We are seeing, of course, that bit of pressure coming in the Asia session. Let's take a look at how futures are setting us up for the start of trade in China. We are keeping eyes on the China data dump. We're going to get some indicators of how the Chinese economy has fared in the past. This is what futures are showing us. We'll look at the Asia Open. This is Bloomberg.